Hey everyone, how you doing today? As mentioned in the daily financial news, we have the lovely and legendary Anna Kelly with us this morning. How you doing, Anna?
I'm great, Michael. So good to be here.
Now you're lovely and legendary cubed or squared. So there you go.
Oh, I love it.
That is awesome. Hey, so one of the numbers that came out this morning was CPI. So CPI for April, the headline number was up 4.2%, right? With a four handle on it.
Wow.
I think both you and I agree that this is, it's not yet a trend, but I think for me, it's one of the first times in my investing career, I at least have to consider that inflation may be running hotter than 2% for quarters or years to come. So I wanted to see if you're in the same boat. And if so, what kind of changes on our investment horizon? What do we do different?
Yeah, so a couple of things. I know we've talked about inflation a little here and there. One of the things that I think is important to remember is that this number, the CPI that the Fed uses kind of to help determine rates and what they're going to do to either cool or heat up the economy, really isn't, it's lower than what real inflation is for most consumers. So it's called the Consumer Price Index, but it's only got a certain basket of goods that they check to see where is the value and the pricing. And so I think real inflation has in most of my lifetime been between 3 and 4%, most would say. Probably, even though the Fed CPI index would say it's 2, right? So I think it's actually higher. And I think even this 4.2% is probably actually higher when you take into account all the other things that prices are going up on that aren't considered part of that basket of goods. So I haven't looked in a while to see what all is in the CPI. I just don't remember. But for example, steel and lumber, I don't think those are thrown into the CPI. At least they didn't used to be.
No, they're not.
Both of them have almost tripled since the pandemic. So appliances have more than doubled in my area. Plus, you can't get them. Houses that are being built are all of a sudden going up significantly, 25%, because of the cost of most of the building materials. So we are definitely seeing some real inflation and higher costs than I can remember in my adult life, since I really started, thinking about words like inflation, deflation, stocks and bonds in the last 25 years or so. So, yeah, it's going up. It is a concern to see how high it will go. Is this a blip in the radar because of the pandemic and supply chain issues? Or is this a result of, all the money flooding the market from the Fed and all the money they're going to continue to flood the market with, trillions of dollars over the next several years?
Yeah, I think the answer to all of that is yes and yes and yes. Right. And again, I haven't really had to think about inflation, right? I have an econ degree and we studied the 70s and, all of those things. And we always talked about gas lines and shortages and, all of those things. And it was all just history book stuff. But I think we've got to crack that period open and at least think about it, right? I know one thing you and I have both done recently is we both tried to de-risk interest rate risk in our portfolio, right? We did that on purpose the last 6 to 9 months, if not 12 months. I think that's a smart move. And it may turn out to be a really smart move if we have kind of a 2 or 3 year run of something north of 2%. Those are things that people need to consider about, especially if you're in multifamily value add, right? You could really have an interest rate shock if it comes due at the wrong time.
Right, you really can. And that's one of the disadvantages of commercial real estate is our rates are typically locked for 5 years. And then after that, they float. We can lock in for another 5 if we want. And there's usually a floor and some ceiling on certain one of those loans. But if you got a loan at 3% and suddenly it goes up to 5, are you still going to cash flow? Can you still pay your investors? And the answer in a lot of cases is going to be no, because these deals are too thin. They're being bought at too high of a purchase price and too high of a loan. So what people don't realize is necessarily that rates in general, the federal funds rate is tied to what they see in the CPI rate. And so, they said early this year, late at the end of last year, that they were going to keep rates low until we achieved a CPI of 2%. Well, suddenly the CPI is now double that. So, Yellen this a week ago, I think, came out and said, oh, well, we may have to start raising rates to cool off inflation. Well, there was a big reaction to that in the stock market. And she suddenly try to walk back that comment because
that's
they're like,
funny.
okay, it's too soon to do this. It's
Yeah.
going to create too much shock in the system. But I think this is going to give them, what they need to say, well, we told you just until 2, now it's 4. We've got to raise rates to cool off the buying of things like real estate.
Yeah.
So, they're going to raise rates. It's just a question of when. And I think it's going to be sooner than later. I think they have to, with all the money that they're printing.
Yeah, I've told people on this channel that I think they start talking about it in November and December, but the actual first raise is in the first half next year. How does that feel to you?
Yeah, last time that they really tried to raise rates significantly was December of 2018, I believe. And it caused a big ripple. And by January, they lowered them back down. So, maybe they try at the end of the year, early next year, but December, January, tends to be a time that they like to do it.
Yeah. And the other thing we need to realize that inflation, it really hits, I don't know how else to say this, but it hurts the poor and working class more than anyone else, right?
Yes.
Because it's gas, it's the grocery aisle, it's the it's Home Depot and Lowe's. It's a really destructive force, inflation is.
Right. And what people, just to talk about that trickle down effect is, as investors, we say, well, when inflation goes up and expenses go up, what are we going to do? We've got to raise our rents because we have to keep up with that increase in expenses. And so we're not big bad landlords that want to price people out of their home. But if our expenses go up 3% and the average landlord only keeps 10 cents of every dollar that we make as profit, we have to raise rents to keep up with it. So it ultimately does help, hurt our tenant and the renter nation. And the same thing if you're buying a house, a single family home, the cost of owning that home is going to go up because your rates are going to go up.
Yeah. And then, the other thing to realize is with inflation, if you own assets, you're kind of, especially cash flow assets, you have that dual protection, right? The asset value will inflate because a house is a big set of commodities, right? And land and all of that. And if it produces rent, it's going to go up. And again, the other thing that I think is happening now, unlike the last 20 years, I think the last 20 years, the CEOs and business owners took a lion's share of the gravy. I see a big pendulum swinging now where labor, the worker, whatever you want to call that category, has more power than they've ever had, which is awesome. But part of the price to pay when labor goes up is each and every individual have a lot more dollars to spend, but that's just another force on inflation, right? So a lot of the, if you go from making $10 to 15 or 15 to 20, but you lose 2 or 3 of that to inflation, it may not feel as good as it should.
Right. And the other thing is that at some point, the prices just can't keep up because then people will stop buying the goods. And so if they can't raise the prices to make up for the increase in labor wages, they're going to start laying people off and they're going to automate. They're going to put in as much technology as they can so that they don't have to pay as many people, inflated salaries. And so inflation is not really a good thing, for very long. Some inflation is healthy. But it could have some effects that people don't realize that again hurts kind of the average worker, the average American.
Yeah.
The other thing that from a real estate perspective, I think a lot about, and I've said this to a lot of my coaching students, right? They hear people buying deals and they put in a 2% expense increase every year and a 3% or 4% rent increase every year. And I've been saying, listen, you cannot do that. You can hope that maybe you can exceed your numbers with a 3%, rent increase or a 4%. And if there's a true value add, then yes, you can raise rents the first couple of years as you turn units and bring them to market. But beyond that, if you think that expenses are only going to go up 2%, you're going to raise rents 4% every year that you own it, you're fooling yourself. And in a day like today where inflation is 4%, your expenses have gone up 4%. And you may not be able to raise rents 4%, depending on how high you are compared to market already. So it's really important. One of the things I think about as an investor now is you've got to be really conservative when you're underwriting your deals, right? We already want to pay less than than market. And that's hard to do in this market. So people are overpaying for some assets. Multifamily is a case in point all over the country because they're viewing it as a place to preserve capital and ride the inflation and hope that the values are going to go up, even though they're not banking on the cash flow, right?
Right.
So you've got a lot of institutional investors buying these assets, hoping they're just going to keep going up. It's safe for a while, and their cash flow is very, very thin margins. And if they're also banking on 2% expenses and 3% rent growth just to make their debt service, they're going to be hurting. So you've got to be super conservative on your underwriting, plan that your expenses are going to go up, and even being conservative as your rents go up exactly the same as expenses. In some market, rents are decreasing, even though expenses are going up.
Yeah.
And that's a real problem. I saw, I think San Francisco and Los Angeles were two of those markets right now that rents have gone down like 20 to 40% in certain buildings, certain asset classes.
Yeah. San Francisco, one bedrooms have gone down 45%.
Wow.
Can you imagine buying a building in the last 18 months and suddenly your rents are down 45% and you have more vacancies and you have more bad debt? Oh, and expenses are up. I mean, that's just a combination for a loss of a property.
It's a nightmare.
Yeah.
Yeah. And again, the average profit is 10 cents on every dollar across rental real estate across the country. Like every dollar that you make, if you're leveraged, you're netting 10% of that.
Yeah.
And so if expenses go up or rents go down more than 10%, you can't cover your debt service.
Yeah. I guess the last question I had, and you've kind of led me there, is, are you changing anything in how you evaluate properties, given that inflation is, something we haven't had to consider, but I think it's at least real now. And what I hear you saying is you're being more conservative on the next deals that you're evaluating.
For sure. Yeah. I mean, I've been a pretty conservative investor, generally speaking, because I wanted to make sure that before I retired a couple of years ago, that I could bank on these numbers working for me for the next 20 or 25 years if I wanted to hold the properties that long, right?
Right.
I'm definitely looking at deals where I'm not assuming that whatever property I'm buying, I can immediately raise rents $200 a month just by putting in stainless steel appliances and painting a pretty color and putting in, vinyl plank flooring. So the cost of some of those items, those CapEx items to put into buildings has gone up significantly compared to the rent bumps that you can actually get for the cost of that CapEx right now in a lot of markets. And so I think we have to be really, really careful in our CapEx estimates and what we think we can get for rents once we purchase these properties. In a time with high inflation, cost of living's going up, people are going to be more frugal and want to back off the amount of rent they pay, and they're going to push back on those rent increases. So I'm just being a lot more conservative to make sure that year one, when I underwrite, looks exactly like the seller's this year looked, or over the last 12 months. And yes, I know and believe with all my heart, I can do better than the seller did now. If I can, make some updates and bring them to market, I'll do better. I'll exceed my expectations. But in my mind, and what I tell my investors is year one, it looks the same. Let's just pretend I can't raise rents at all. Let's pretend I can't use this CapEx money. Let's pretend I have higher bad debt and vacancy year one than what I know I think I should be able to achieve. And that way I've got a lot of wiggle room in case these things start happening. Year two, I'm going up modestly. Year three, after I've updated all my units, then I start ticking up. But again, my expenses and my rent increases from that point are they're even. So I'm assuming no real change in years 3 through 10, that rents and expenses are just keeping up with inflation.
That's awesome.
And that way I'm not overestimating what I'm going to be able to make, when I know in reality, most years are going to say I'm going to make a lot more than what I think I'll make or what I'm modeling before I decide to purchase the property.
Oh, that's awesome. And that's really the benefit of being able to look at multiple markets across the country. As I've shared many times, I've kind of been lazy and only look at one market. So in what I'm doing in my business is I'm not even evaluating multifamily today. It's grossly overpriced. I own some, so I know what bad debt looks like, and rents are actually down a little bit in apartments, but they're up in houses. So what I'm doing in my business is I'm just looking for single family homes. I mean, probably for the next 12 to 24 months, I will add units, but they will all be homes. In my market, they can't build them for less than 450, and I can still pick up decent homes that are 40 or 50 years old for, under 250. So I'm just going to go add as many of those. And oh, by the way, yes, as we said earlier on, I'm going to go get that 30-year debt. Right. Even if I have to pay 5.5 because I can't get, cheap bank loans, I'm going to be happy to do it. I'm just going to get as much 30-year money as I can.
Yeah, that's really smart. If you can definitely get the 30-year fixed loans, Fannie backed, that's going to help you ride out any big bumps in the interest rates.
Yeah.
For me, for my market, and again, we've talked about this before, but it's very regionalized and every market's a little different. Like in my market right now, the issue is on single family homes, you cannot get the same rents in my market as a percentage of what you pay for the property, because they kind of tap out, where because of the income level of my area, it's above average income. If I have a house that I have to pay $250 for and my rents are going to tap out at $1,600, I don't meet the 1% rule. I'm not going to cash flow. Yeah. And if someone's going to pay more than $1,600, they're going to go buy that house themselves. Yeah. So the single family homes in my market, that's slightly above average income, generally the rents just won't keep up with what the houses are going for today. So you have to find really great deals, off market properties, et cetera. Where some of my smaller multis, because we do have a shortage in supply in my market, significantly decreased supply, lots of demand, my multifamily rents are keeping up.
Oh, nice.
Compared to the single families. But you've got to know your market. You've got to look at what's going on there and what's going to be the best strategy for you, and to kind of counteract this inflation. But bottom line, own assets.
Yeah.
As inflation goes up, asset values go up, and you will create net worth if you buy right.
Yep. Yeah, buy assets and do whatever you can to remove interest rate risk. Like you and I did early in the first part of this, we took our debt that was coming due in the next 2 years, and we're like, we'll pay points if we have to, right? Prepays, and we're going to extend that. So pretty smart stuff. So thank you very much, Anna. This has been a lot of fun.
You're welcome.